Good afternoon, and thank you for joining us for today's Simplified CISO Tool webinar. I'm Gerardo Mesa, a program analyst in the Office of Credit Union Resource and Expansion at NCUA. Before we begin, I have a few administrative announcements. If you're having any problems hearing my voice, please adjust the volume on your computer. And if you're still having problems, use your Ask a Question feature on the bottom of your console and send an email to our support team and we'll help you right away. Please make sure that you allow pop-ups from this site. In approximately 2 weeks, the webinar will be closed captioned for an on-demand viewing in the NCUA Learning Management System, or LMS. You will be able to review the webinar and download a PDF version of the presenter's PowerPoint presentation. You can also download the slides today by clicking on the registration link for this webinar and entering your contact information again. You will get a message saying that you have already registered for this event. Just click OK. You will be able to take you to a landing page where you can download a copy of the slides. You must have an account on the LMS to view this webinar, as well as other valuable training. There is no cost to access LMS, and it is only available to credit union volunteers and employees. To set up an account, go to ncua.gov, support services, credit union resource and expansion to find the link under LMS. There are currently over 100 courses on various topics. Next slide. The materials presented in this webinar are intended as an informative and educational summary of general information about the simplified CISO tool. The NCUA has taken reasonable measures to ensure the quality of the data and other information produced by NCUA that is available in this presentation. The NCUA, however, makes no warranty, express or imply, nor does assume any legal liability or responsibility for the accuracy, correctness, or completeness of any information that is available through this presentation, nor represents that its use would not infringe on privately owned rights. The slides are intended for educational and discussion purposes and do not constitute legal advice nor replace an independent professional judgment. Reference to any specific commercial product, process, or service by trademark, trade name, manufacturer, or otherwise does not constitute an endorsement, recommendation, or favoring by the U.S. government or NCUA. Next slide. This is our agenda for today's webinar. We will start with introductory remarks from Christy Kubista-Hovis, Resource Division Director in the Office of Credit Union Resource and Expansion, followed by an introduction of our speaker. We will have time for questions and then close out the webinar. Next slide. Okay, it looks like we have a polling question. Please let us know the size of your credit union by answering the following questions. A, up to 50 million in assets. B, 51 to 250 million. C, 251 to 500 million. D, 501 to 1 billion. E, over 1 billion, or F, not a credit union. See here, we're starting to see the overall picture, and it looks like we have a good variety of credit unions, as well as, it looks like most of the attendees right now are under 50 million. Okay. I will now turn the program over to Christy Kubista-Hovis, Resource Division Director.
Good afternoon or good morning to you, depending on where in the country you are. I'm Christy Kubista-Hovis. I am the Resource Division Director, responsible for all the training and development activities for that NCUA has for credit unions, as well as our loan and grant program and our MDI program. So I am very pleased to have with us today for our monthly webinar. Chris McGrath presenting today on the Simplified CECL tool. Chris has a wealth of experience here at NCUA, as well as in other federal and private sector areas. As the NCUA acting chief accountant, McGrath serves the credit union industry with advising guidance on the application of generally accepted accounting principles. Prior to joining NCUA in 2004, McGrath practiced in financial auditing and insurance with Deloitte and Touche, including 3 years working out of Istanbul, Turkey, auditing multinational companies under the US GAAP and international financial reporting standards. For NCUA, he has served in a wide variety of functions, including the budget officer, as well as writing and leading the financial reporting on its funds. Under McGrath's tenure, NCUA has earned its first certificate of excellence in accountability reporting from the AGA for the 2016 annual report. With that, I'd like to turn it over to Chris and leave the webinar in his very capable hands. Thank you.
Thank you, Christy. Thank you, Geraldo. Well, thank you for joining us today. We will be covering the Simplified CECL tool. And this tool was created in response to the industry being concerned about applying CECL. Today, we're going to walk through a refresher. We're going to go over the Simplified CECL tool and then give a demonstration of it. And of course, at the end, we will respond to your questions. Next slide, please. The overview, we're going to cover some common topics like, when to implement CECL, what is my financial statement year, and how to record the one-day adjustment. And how does the CECL transition rule work? First, let's start with the overview. Let's keep it simple. CECL is our desire to determine the losses that we will have on loans based upon the life of their loan, their contractual remaining life. There are a lot of words on this page. And when I looked at the original release, the Accounting Standard Update 2016-13, it's 291 pages. That's a lot of words. But let's keep it simple. There's a lot of words on this page, but really CECL at its core is trying to get us to a better place. It's trying to get us to be able to estimate the losses on our loans, on our securities where they're on our debt securities, and to be not only thinking about what has happened in the past, but going forward, thinking about our future, thinking about the future economy and how that will affect our ability to make collections. CECL does not apply to anything that is carried on the books and records at fair value. It's focused on loans, receivables, unfunded commitments. CECL recognizes losses faster and is more accurate. Because of that, losses are an estimate. Losses are to cover the life of the asset, the life of the loan. Also, the concept of contingent probable losses is gone. CECL is an estimate, and we're getting at the losses, even if the risk of loss is remote. So long and short, CECL is allowing us to get a better estimate of the losses that management expects to incur on its loan portfolios and on its debt securities. Next slide. You guys will like this. CECL does not apply or does not need to be calculated for. That is, credit losses do not need to be calculated for securities where the expected loss of where the expected non-repayment is zero. So these are things like Treasury securities, securities from government-sponsored enterprises like Fannie Mae, Freddie Mac. So while this page lists all the things that are covered by CECL, there are, where we have government-backed securities, you don't need to go ahead and calculate the credit losses on those. So moving from, looking at this page, this is a quick snapshot of what CECL covers. Before I get into this slide a little bit, I want to talk about the summarized CECL again. So CECL is meant to be scalable. CECL contemplated that financial institutions would use their old methodology, but make up adjustments to it. They will add to it the life of loan concept and the concept of current conditions and reasonable and supportable forecasts. That is looking into the future. Okay, now, actually, please go back a slide. Okay, so I like to call this slide one-stop shopping. So from top to bottom, you can see what CECL applies to and what it doesn't apply to. It's very broad in scope. Again, CECL does not need to be applied to securities or items carried at fair value. The other thing I want to point out here is CECL did away with the concept of other than temporary impairment. And that's for available for sale securities. But what they did put in place is that credit losses must be assessed when the fair value is less than amortized cost. Doesn't mean that a credit loss exists, but for available for sale securities, you have to, when the fair market value falls below the amortized cost, you have to take a look at it to see if a credit loss has been incurred. Okay, next slide. For most credit unions, CECL will be effective January 1st, 2023. CECL uses the language a modified retrospective, and this is unusual language. That is, when you adopt CECL anytime in 2023, the standard requires that you go back to the beginning of your fiscal year and make your cumulative adjustment, that is, make the adjustment for adopting CECL into your undivided earnings. This means that for a calendar year credit union, you'll be calculating your allowance for credit losses as of January 1st, 2023. You'll be using December 31st, 2022 numbers to calculate what that allowance for credit losses should be January 1st, 2023. And your adjustment to your undivided earnings will be the difference in your allowance for credit losses as of December 31st, 2022. And the new allowance, the allowance for credit losses on loans and leases as of January 1st, 2023. The difference goes into your undivided earnings, whether it is an increase or a decrease. Most likely with the adoption of CECL, your undivided earnings will drop. Next slide, please. Now on to your first day that you adopt CECL. Most credit unions, federal credit unions, have a fiscal year. And however, some credit unions are audited or they receive, preparation of the financial statements on a year that's other than a calendar year. They may have their CPA accountants come in and do procedures on a year that's not a calendar year. And that's allowed. CECL, the term fiscal year for federal credit unions means a calendar year. But FASB GAAP allows a credit union to have financial statements on a year that's not a calendar year. So if you are getting a CPA audit as of a different year end, like September 30th, 2023, you'll be adopting CECL October 1st, 2023. That's also starting the first day for the CECL transition rule. We put out an accounting alert to explain this. Working with our attorneys, we determined that a federal credit union must have a calendar year. But as I said earlier, FASB GAAP allows a different fiscal year for financial reporting. Next slide. English is a wonderful language. I like to say that it's pretty good, pretty bad, pretty ugly. I have no idea what pretty means. So the same thing happens with audit. CPAs, when they think and use the word audit, they're thinking of an opinion that they give on financial statements, their audit opinion. However, in our regs, we have the supervisory committee audits. And this audit may not necessarily be that financial statement audit conducted by CPAs. So while FASB GAAP uses fiscal year, the idea is that it's for the preparation of a full set of financial statements, the balance sheet, the income statement, statement of cash flow, and notes. However, some credit unions may not be getting this full level of service, or this may be doing what's required under our regs as the minimum procedures. And this may not set the precedent for a fiscal year that is other than a calendar year. Long and short, there needs to be a precedent set of preparing financial statements, the balance sheet, the income statement, the statement of cash flow, and notes for a year that's not a calendar year. And we have put FAQs out on our ncua.gov site for this. And please take a look if you have any questions, as well as, you can always send an email off to eimail@ncua.gov. We'd be glad to answer any questions you have. Next slide. Well, by now you're aware that CECL is effective January 1st, 2023 for most federal credit unions, for most credit unions. And I like using T accounts because this is showing the impact on undivided earnings. In this example, we see a credit union with a balance prior to CECL of 10 million for their allowance for allowance for losses on loans and leases. And with the adoption of CECL January 1st, the allowance for credit losses becomes 12 million. So it's an increase in that allowance, that reserve, by 2 million. The increase creates a decrease in the undivided earnings or retained earnings. So this is what we call the one-day adjustment. The books and records must show GAAP. So that increase has to be recorded in its full amount to undivided earnings. There's been a little bit of confusion about, the CECL transition rule, and we'll get into that shortly. But actually, let me jump into it right now. With the CECL transition rule, which talks about the amortization of that day one adjustment, there is no adjustment to the general ledger for this. This happens all outside of the general ledger. Next slide, please. The general ledger always needs to be in compliance with GAAP. The CECL transition rule is not establishing GAAP. It's actually establishing the regulatory capital. As I said earlier, there's nothing that's done in a general ledger. This happens all outside the general ledger. The CECL transition rule provides a benefit to the net worth ratio for prompt corrective action of adding back the day one adjustment. And that day one adjustment is going to be amortized over 3 years. I'll show that. There's a slide coming up shortly on that. In the call report schedule, Schedule G will have two line items, which you will enter to provide that information. The transition rule applies to credit unions that are 10 million and more. and undivided earnings must decrease. The add back is 100% for the first 3 quarters of 2023. Next slide, please. Remember that earlier example of the 2 million? This slide is to show the transition effect of that $2 million, that $2 million day one adjustment. And noted below is if your fiscal year is different than the calendar year, well, then this adjustment begins the first day of the 2023 fiscal year. In this example, September 30th, 2023 is your fiscal year end. So CECL was adopted October 1st. So for the call report in that Schedule G, by entering your CECL adoption date on line 1 as being October 1st, 2023, and on line 2, that 2 million, the call report will automatically calculate and apply it over the fiscal years beginning from October 1st. Next slide, please. Okay, here we have it. This is how that $2 million gets amortized over the next 3 years. And we're using a calendar year for this example. And as you see, for the first 3 quarters of 2023, the 2 million is added back to both the top number and the bottom number. And at the end of the first year, end of the first quarter, there is a reduction from 2 million of an add back to 67%, or in this example, 1.34 million. So this add back decreases as we go over time. So by the time we get to the end of the second year, the add back is 33%, or $660,000. And by the end of the third year, the add back is 0. What this does is, for your net worth for prompt corrective action, it gets adjusted downward over time, giving credit unions times to adjust for the implementation of CECL. And this is very similar to what's the option that banks have for their CECL transition rule. And we do this automatically for all credit unions that meet the eligibility requirements. Next slide, please. One thing I want to talk about is for credit unions under 10 million. Now, credit unions under 10 million can adopt CECL, whether you're state or federal. And if you adopt CECL, you get the benefit of the CECL transition rule. However, within the Federal Credit Union Act, GAAP is not required for credit unions under 10 million. The CECL transition rule talks about any reasonable reserve methodology incurred loss that adequately covers known and probable losses. So this is our old GAAP, our old incurred loss methodology. Next slide, please. Okay, so this starts going over how the tool works. Next slide. Okay, we developed this tool for credit unions with assets of under 100 million. And as we were looking at this, we went and found loan level data for credit unions under 10 million, 100 million in asset size, to develop the life of loan, or what we call the weighted average remaining maturity factor, or WARM factors. So these factors are automatically put into the tool, which we'll see shortly. Larger credit unions can use this tool. However, we put the caveat there that they need to take a look at these WARM factors. They need to take a look at the makeup of their portfolios and compare them with the portfolios that are used in the tool to see if the factors are comparable. The other thing that happens is, the other thing that's important is the tool should be updated for qualitative adjustments. That is, the tool should be refined and calibrated for each particular credit union. Every credit union is different. The facts and circumstances for every credit union is different. And as they're using the tool, they need to take a step back and say, is this tool really presenting my allowance for credit losses on loans and leases? And do I need to make adjustments so that it does represent management's best estimate of credit losses on loans and leases? Next slide. One of the I want to thank Val Gathani and his team for putting together the tool, which you'll see shortly. They put a lot of work into this, and it's really made, as you'll see shortly, this whole process simpler. The CECL tool is based upon the weighted average remaining maturity framework. This is a framework supported by FASB, and it includes things that you're very familiar with the old method. You're segmenting loans into types, into groups. In this, with the tool, we're doing it by the call report. So the lines that you see in the call report line up with the tool. Separately, we have a specific reserve, or for loans that are impaired. There's a tab for that. Also, we're using historical charge-off rates, which is very similar to what you were doing before with the incurred loss method. The difference now is we're adding those two concepts we talked about earlier, the life of loan concept and the qualitative adjustments. Next slide, please. So this tool is pre-populated with each credit union's historical charge-off rates. So when you enter your charter number, those rates are automatically populated. We've had to make some groupings of those groups, those loan portfolio segments, because of, as time has gone by, we have changed the call report. Also, these net charge-offs are historical. They do not contain any qualitative adjustments, or formerly called qualitative and environmental adjustments. Next slide. As I talked about earlier, we found credit unions, we found data on loan levels. We found loan level data for credit unions under 100 million from an external contractor, and they have been anonymized, and they have provided to us the weighted average remaining life factors, and that's included in the model. So for credit unions under 100 million, those WORM factors should parallel your loan portfolios. Mind you, you need to check it, but they're set, those WORM factors are set for credit unions under 100 million. And we update the tool quarterly to update these factors so that it is it keeps pace with what's happening in our economy. Next slide. I'd like to use this visual representation of the WORM factor. Remember the incurred loss method where we took the loan balance and a loss rate? Well, this is very similar. We're taking that loan balance, we're taking that loss rate, that historical loss rate, but we're adding that life of loan. What is our expected losses over the life of this loan, the contractual maturity of this loan? And then we're also adding qualitative adjustments, and these qualitative adjustments include current conditions and reasonable and supportable forecasts. So I like to use the term, we have to look into the future. What's going to happen 1 or 2 years with the economy that's going to affect our losses on our loan portfolio? Next slide. So the allowance, the reserve, is an estimate. Examiners will take a look at your policies and procedures. That's going to take a look to see if the allowance is reasonable. They're going to take a look to see adherence with GAAP, as well as your day one adjustment. Okay, next slide. Hey, it's time for the demo. Okay, so with that, let's go take a look at the tool. Okay, so on our first page, we have the overview. This is our disclaimer. Basically, we're providing this tool, but this tool is only as good as your input. your input needs to go into this tool, and you need to show ownership of this tool. And from putting information in, the data in, taking ownership of this tool, you're going to get a good result. Tab 0, please. Oh, sorry. Actually, no, it's up to me. Boy, so I get to click to tab 0. There we go. Okay, so this is the first page, the first input page. And in the upper part of this, you see your credit union number. This is your charter number. And if you enter the wrong number, it will say credit union not found. However, we put a sample in here, and we're using the tool as of December 31st, 2022. And this is to get to the allowance for credit losses on loans and leases. That would be for the day one adjustment. The value that we would get to for this will be compared to your allowance under the old method, and that difference would go to your retained earnings or undivided earnings. So if we're thinking about the day one adjustment, after we load your charter number, you enter the balances for your loan portfolios. These will be the balances that tie to your call report submission as of December 31st. When you do this for March 31st, 2023, these balances here would tie to your call report submissions for March 31st, 2022. And numbers can be simply put in, adjusted, and everything updates. As I said, when you enter your charter number on tab 3, this column here called historical loss rates, column G, that will automatically update. Okay, so let's go back to this tab here. One thing I want to talk about is if you're having trouble seeing the screen, in the top is like some plus and minus signs. You can use that to enlarge or make smaller the window so you can see things. All right, tab 1. Here's the loan palette balances from tab 0. And what you'll see here is that we're adjusting them for the individual, for loans that, well, I call this the specific reserves. These are the loans that we will have that are not fitting the normal risk qualities of our regular of our loans that we are pulling to come up with the CSO allowance. And then as we move over to loss assessed on a pool basis, this is our general reserve. And this is tab 3. This is what this tool is calculating based upon the WARM methodology, taking that historical loss rate, taking the life of loan factor, and adjusting qualitative factors. We are going to come back to this page, but ultimately, once we get through the remaining tabs, this value here in the bottom right-hand corner is going to be your allowance for credit losses on loans and leases as of as of March 1st, 2023. So this jumped to tab 2. And tab 2 is your specific reserve. CECL did not change the way you go about doing your specific reserve. What you've done in the past to come up with the balances that you expect to be collected, it's the same. I'm going to slide over here. And on this tab, you can enter your member information, their account number, etc. And in the loan balance, this is the loan balance as of, in this case, December 31st, 2022, and the amount that you expect to be collected and what you expect to be recovered. If this is perhaps a secured loan, maybe this is the the value of the security less the cost to sell. And you update this, and the total at the bottom here, the amount that you expect to be collecting off of these $47,500 worth of loans is your specific loss for all other unsecured loans. We do the same thing. We have the same thing here for new vehicles. Here somebody has a $51,000 loan. We expect to recover $40,000. So our specific loss for this is $11,000. And at the bottom, it totals it up. And if you run out of room, you can right click over here and you can add a row and it will automatically update the formulas. Be careful in doing some copying and pasting because that can script the formulas. Okay, so we talked about these values here, like for the new loans. When we go back to tab 1, you see this 13,500? When we go back to tab 1, we see that 13,500, so it carries over. Now let's get to the pooled basis. And this is the entire, these are all the numbers. I'm going to blow this up so you can take a deeper dive into this. But what we're seeing here is the original loan balances, your loss histories, the life of loan, and then all the way over, this is going to be the allowance for credit losses by each loan portfolio category, and then summarize becoming to be totaled for all your loans and leases. Let me make this a little bit larger. All right. So moving from left to right, again, we took those 13 loan portfolio segments that are in your call report, and we had to combine several of them because of our call report data structure has changed over time. And we calculated those loss histories and updated them based upon those loan portfolio categories. So this is your balances for this example as of December 31st, 2022. We're subtracting out those loans where we did a specific reserve, which was on tab 2. And then this gets us to the balance that we're going to apply the warm method to. These are our pooled loans. The next column is our historical losses, or your historical losses. So when we entered this number here, it updates your historical losses. And here they are. And on our website, we have a Excel spreadsheet that shows where these values come from for the tool, for the March 31st, 2023 tool. So you can see exactly where the numbers come from that calculate these values. So this is historical loss. In CECL, we have to think about, well, current conditions and reasonable and supportable forecasts, the future. So being historical losses, these may not include maybe increase in loss trends for the last couple quarters. In this case, this tool for as of December 31st, 2022 doesn't include 2022 losses because we didn't have the fourth quarter losses yet, the year-to-date losses for 2022. So in taking a look at unsecured credit card loans, we may have an increase in trend. And in this tool, we provided tabs where you can modify, add information. In this case, our current loss rate on unsecured loans is 1.24%. It's 1.24%. So on our credit cards, our historical average is 1.24, but we've had a trend. Management estimates that we're really going to lose 2% on these credit card loans. We're forecasting perhaps a moderate recession, and we're expecting delinquencies to increase. So our target rate is now 2%. So the way the tool works is, here's the old rate, here's where we're targeting. So we input the increase, this 76 basis point increase, into the adjustment tab. And you can either enter the number in, or you can even do a formula to another page to pick that up And that's your qualitative adjustment in tab 4 for your loss rate. And as we go back here, we see here's our historical loss rate. Here's our adjustment to get to our target rate of 2%. So these historical adjustments, these qualitative adjustments should be, you should take a look at them and consider them for all your portfolio line items. Make sure that your estimated losses are your best estimate. Again, CSO requires you to take a look at the historical, but update it to what's currently happening and what you anticipate to happen into the future. And that future, rule of thumb, that future period is like 1 or 2 years into the future. So this is an example of an adjustment to that historical loss rate. Now, this sample has auto loans. And you notice here, we have a loss history of 20 basis points, and we did a qualitative adjustment. So management's targeting a 35 basis point loss on new auto loans based upon recent trends, and they're looking into the future. And then they're also taking a look at, well, this tool automatically provides your life of loan or weighted average remaining maturity factor. This, again, is based upon credit unions that are under 100 million. And as an example, we have here a summary of where the WARM factors, summary of the WARM factor qualities. The balances, accounts, the weighted average maturity. And then from this is a WARM factor. And if you divide this by 12, you get 1.87. And of course, we have a prepayment speed, which comes from either, taking a look at this loan level data and also taking a look at industry inputs. An example I like to use for new vehicle loans is, here we have a WARM factor of 1.87 years. And the weighted average maturity is 59 months. Basically, these are 5-year loans. But suppose your credit union only makes 7-year loans. Well, this WARM factor needs to be adjusted. And it would be, let's go and do a little calculation here. Okay. The current factor is we'll just go right to the table. And we realize that's for a portfolio that has 60 months. And let's do 84. There we go. So this is how we're going to divide things and multiply. And we'll get to our adjusted. So I'm just simply going to take the 1.87 divided by 60 months. And then I'm going to multiply that by 84 months. Oops. I just try this again. Take 2. Oops. Divide times. And here's our new factor. This is our target factor. And the increase is basically 3/4 of a year. And in the tool for the new loans, we're going to add this adjustment. I do 7 years or 8 years? 7 years. Okay, so we're doing an adjustment for 7 years, because all of our loans are really 7-year loans because cars are expensive nowadays. And then when we go back to this tab here for new vehicle loans, we see that we've adjusted our life of loan to that target value of 2.62 years. And then of course, over in the right-hand columns, we have the original CECL allowance based upon historical losses. We have our qualitative adjustments to fix that, in this case, the worm. And then we have our final allowance for credit losses for this loan portfolio. And at the top, you can see the same thing that we did for the credit cards. You know, having a 2% target rate adds up over $500 and gets us to nearly $1,400 worth of losses. So down here in the bottom right-hand corner, this is a value that comes all the way over and back to tab 1. And when we add everything up, we get our allowance for credit losses on loans and leases. So I'm about ready to wrap things up and get to questions. But what I also want to do was say that this tab 4 is the hardest part, because this requires your judgment. This requires us looking into the future and trying to figure out what's going to happen. And that's hard. It's not easy. But there's information that might be able to help you out. You know, we have the underlying values, the characteristics for each loan portfolio, including where we have segments, like for new auto loans, direct and indirect. We also have historical losses by your tiers. And then we also have a checklist. And I had talked earlier about like ownership. And one of the ways of showing ownership of this is working from top to bottom and making sure that these steps are completed in preparing the tool. And with these steps completed, you know, you've shown ownership and you have support that the value that you have here on tab 1 is your complete supportable allowance for credit losses on loans and leases. And all we're doing here is we're just taking your specific reserve plus your general reserve, getting to that value, and tabs 2 and 4 document how we got to that number. Okay. Kind of flipping my notes here for a second to make sure there's nothing I forgot about, but I think we're in good shape. And with that, let's get to some questions.
Thank you, Chris. Great presentation. A lot to take in. And since we have time, let's go ahead and see what questions we have. If you have any questions, please use the Ask a Question feature. If we don't get to your answers today, we'll answer them and include them in the webinar recording when it's loaded to the LMS. I would like to introduce Ron Good, an instructional system specialist in the Office of Credit Union Research and Expansion at NCUA. He will be asking the questions. Thank you.
Great, thank you so much, Gerardo, and also thank you, Chris. Great presentation, lots of wonderful information. Definitely helped me understand CECL and the CECL tool better. So we have a lot of questions. So I'm going to start with this one, Chris. And the question is, I noticed in the call report, there are questions in the assets section concerning CECL adoption on certain types of investments. Yet I see nothing in the simplified CECL tool involving investments. Is there another tool or reference for us to use to comply with CECL?
There's no tool for investments, or also there's unfunded commitments, which is a liability. So for available for sale debt securities, CECL requires a an evaluation for credit losses. And the methodology talked about within the accounting standard is the discounted cash flow method. For held to maturity securities, CECL also requires credit losses to be determined. And a common methodology for the held to maturity is to take a look at the credit ratings of the issuer. AAA, Moody's has historical information where you can see the historical losses, not only probability of default and loss given default. They have historical information out there on their site. And of course, for a paid subscription, you can get even more detailed. So that's a common method to get at determining credit losses on debt securities. Of course, please also reach out to your accountants as they may be able to provide information approaches to make this much more handleable and help you come up with a number, an estimate.
Excellent, thank you. The next question is, if the credit union has over accrued funds in the allowance for loan and lease losses and wants to keep it that way, is it necessary to adjust the CECL worksheet so that the calculated amount on the summary is close to the actual amount in the general ledger?
Well, I'm a GAAP person, so I'm going to talk about being compliant with GAAP. So if management's taking a step back and saying, hey, what's coming out of this tool looks too low, then management should take a look and say, okay, do I need to do qualitative adjustments to get to what that real number should be? So what that best estimate should be. It's the best way of terming it. So we be going back, doing qualitative adjustments and taking a look at your loss histories, taking a look at the warm factors, and making sure it's taking a look at current conditions and also taking a look into the future. And that number that the tool comes up with is a number that you adjust your general ledger to.
Very good, thank you. Our next question is, what if the CECL calculation shows a negative result?
My first instinct off of that is to say that maybe the tool needs to be looked at again to see if qualitative adjustments are necessary, required. Also go through that checklist that I showed from top to bottom. So the first, again, go back. If the tool is giving you a result that's not making sense, you guys know your business. You guys know, your loan portfolio. You know your customers. You know your business. So if the tool's not giving you a result that aligns with what you know about your customers, well, then go take a look at what's going into the tool to make sure it reflects your business. With that said, there was I did have a credit union reach out to me, and basically they said, well, we had over reserved under the ALLL with using our Q&E, and we hired an outside consultant, and we took a look at your tool, and both people, Bull and the outside consultant, came down with a lower number than what we had in our general ledger. And they decided to, well, actually they had to, under GAAP, go to their best estimate, which was lower than what they had reserved for, which resulted in a decrease in the allowance for credit losses for loans and leases. And, basically a credit to their undivided earnings. With respect to a decrease, the CECL transition rule does not apply because you're actually in a better shape because of adopting CECL. All right, hey, on to the next question.
Great, thank you. And I think this next question, you may have touched on it in your last answer, but I'm going to go ahead and ask it anyway. What if we cannot quantify qualitative measures?
Oh, I will have to say that, again, it is the hardest thing to do. And obviously, we want to be able to root our adjustments in like some type of numbers, some type of quantitative. But sometimes we can't. Or sometimes it's a probability. And my example of probability is, okay, here we have a case. During the Great Recession on new auto loans, we lost 3%. Well, are we in a recession now? No. The Federal Reserve is talking about a moderate recession. So, during the Great Recession, we lost 3%. We're not anywhere near a recession. So it may be taking that 3% and multiplying it by our probability. Like, maybe we are halfway going into a recession, a moderate recession, which would be 50%. So it's going to, so it'd be that 3% times 50%, giving us a 1.5 target for a loss rate. Again, doing these qualitative adjustments is not science. It's part art and science. And it is the hardest thing to do because coming up with estimates, it can be challenged. We need to take a step back and say, is this reasonable? And, I wish there was, a black and white, hey, just plug it in and it will come out with a great number. But no matter how simple or how complex the model is, there's still a realm of it's an estimate. And as management, management has to take a look at that and say, is this really representing what's happening with my customers, my business? Is it reasonable? So yes, try to come up with that qualitative, that estimate. It doesn't, it doesn't need to be 100% supportable with numbers, but it needs to be 100% supportable with your logic and being able to convey that logic and how it's going to affect your losses.
Very good. Next question. Thank you, Chris. Next question. Do we have to adopt a new CECL policy?
You should update your policy to be in compliance with GAAP. So CECL requires, as I talked about, life of loan, life of contract, contractual maturities, also reasonable and supportable forecast. However, you don't need to change your chart of accounts. You can use your old accounts. The ALLL can also be used now for ACL. If you were doing it monthly before, you can do it monthly into the future. You don't have to go to a quarterly method. We put that tool out there to be to help you guys. And if you want to, if your policy says, hey, we're going to update our allowance for credit losses on a monthly basis, well then, or let's say right now we have the March tool out there for the March call report. So if we're doing April and May, we use the tool at the March tool and update it. At the end of April, we use our loan portfolio numbers as of April, update our assumptions, and come up with a new number and adjust to that. And then we do the same thing for May. And in June, we'll have a new tool out there with updated WARM factors based upon what's going on in the economy. And you use that for June. So yes, your policies should be updated to reflect, what needs to be in there for being compliant with GAAP, as well as good sound management practices for making sure that you're following, this risky area of allowance for, allowances on your loans.
Thank you, Chris. And since we're running out of time, there's two questions that came in that are similar. So I'm going to ask them together from two different people. The first one is, should this spreadsheet be completed on a quarterly basis only, since we cannot change the date? And the second one is, how often are the assumptions updated in the simplified tool? Should this spreadsheet be downloaded quarterly from NCUA?
Yeah. So first of all, we can, I'm willing to run over the 1:30 time limit to make sure you guys' questions are answered. So getting back to the tool. Yes, you can use the tool in months that are not quarter end. In January and February, April and May, you would just use the latest released tool, as I was talking about, like for March, we would use the March tool for April and May. The tool is going to be updated every quarter, and every quarter we update the weighted average remaining maturity factors, and every year we update the loss history. So the December 31st tool contains an average of your loss rate for 2019, 2020, and 2021. Our best loss histories come from the fourth quarter. We haven't been able to figure out a way of annualizing loss factors loss rates that come in earlier quarters. So when we put out the March 31st, 2023 tool, we included a look back for 3 years, and that included the year 2020. Make sure I get this correct. 2020, 2021, and 2022. So the most recent tool has your losses through the end of December 31st, 2022. Okay, next question.
Very good. Thank you so much. So our next question is, can you please tell me where I would enter the data for unfounded commitments?
Oh, unfunded commitments. Okay.
Unfunded, I'm sorry.
No worries.
My mispronunciation. Unfunded commitments. Sorry.
I'm sure the people out there want them to be unfounded. Okay, so unfunded commitments. Unfunded commitments is actually a liability. So on the call report, we have a line item for that. I can't remember that offhand. It's a liability. And again, these are your, these are the uncancelable commitments. And it is to come up with what is that expected loss to have on those loans you will put in place, but haven't gotten in place yet.
Excellent. Thank you so much. Okay. What about bank HTM classified broker CDs? Do we need to recognize losses?
Okay, so this is a tough one because you have insurance, and theoretically, if you have over the insured amount, $250,000 in a institution, then you should start thinking about, okay, what is the potential for a credit loss on these CDs? So hopefully you have them under 250, but if they're over, then take a step back, maybe take a look at that credit rating for that institution, and hopefully they're high quality. And there's a method of, that probability of default, loss given default, which we talked about from Moody's, which may get at what a credit loss expectation would be, or credit loss estimate would be on those values above the insured amount.
All right, on to our next question. Will independent validation be required on the NCUA CECL Simplified tool? I don't understand the CECL changes to TDRs. Is the change just semantics from TDRs to loan modifications and everything else remains the same? On slide 18, why are early adopters ineligible for the one-time capital adjustment?
Okay. Oh, we get a bunch here. So let me back up a little bit okay, I remember TDRs. We talked about troubled debt restructurings. So TDRs were accounted for especially using a discounted cash flow methodology. And that discounted cash flow basically included that life of that loan. So when they implemented CECL, they said, well, CECL is getting at the same thing that we're doing with TDRs. So the way we're accounting for the special accounting that we're doing for the TDRs, well, guess what? That's just going to roll in to become part of the CECL, the way that you estimate your credit losses on your loans. So that special accounting went away, but in effect, CECL was picking up that life of loan concept that we were doing with the TDRs. Now, that TDR term also went away, and it became loan modifications to borrower. This is a tongue twister. Loan modifications to borrowers experiencing financial difficulty. And though it's similar to, troubled debt restructurings, the disclosures around it are different. And the GAAP required disclosures get into, tracking those loan modifications for 12 months and disclosing whether there's a subsequent default, et cetera. So, consult your accountant and CPA advisor on required disclosures. But loan modifications is a little bit different than TDRs, but we're getting at the same type of loans that are, having difficulty, that are in trouble. And then, what was the last part of that question?
Hold on, let me go find that one for you again. I'm impressed, Chris, because that was a good question, but it was a complex one. And you did a good job. The second half was, is the change just semantics from TDRs to loan modification and everything else remains the same? And then they said on slide 18, why are early adopters ineligible for the one-time capital adjustment?
You know, I really can't speak too much to this because the rule was put in place before I became the acting chief accountant. In thinking about it was, in developing our policies, we wanted to keep things simple and give a benefit to credit unions. And I don't have a good answer. I can't answer that one.
Okay.
So I can't answer that one. Yeah, I wish I knew, but I can't answer that one well. So.
That's it. That's fair. I understand. Okay. Our next question, I think, is a lot easier one for you. How do you know how much you expect to collect?
Oh, okay. Good question. Very good question. Okay, we always know that past performance is the best indicator of future performance. And that's why we take a look at loss histories. So, for things that are unsecured, that's where we try to hang our hat, which is, our past performance. Now, with respect to collateral dependent loans, well, there we can go to, hey, what is going to be what we expect to collect if we, repo this car and sell it? What's going to be the expected, collection after selling costs, et cetera. So that's a way of getting at the amount to be collected. When I talked about, past history, again, CECL did not mean to change the way that you did your specific reserves in the past, now. How you were doing your specific reserves for those loans that are, troubled, that don't fit your normal, that are impaired or you don't expect to collect on, that continues. CECL also requires that you think about pulling out those loans that don't fit the normal risk characteristics of your pooled loans, and also individually valuing them, estimating the losses on them. Okay.
Excellent. Thank you. We still have plenty of questions. We may wrap up soon, but let me keep plugging on. On tab 2, individual basis, what loans do we enter here? Charge-off, bankruptcies, TDRs?
Let me share my screen. So, all right. So this is where we enter troubled loans. So you can enter TDRs here because they usually have a risk that's higher than your normal loan portfolio. So these could be delinquencies. Now, when you have a charge-off, that charge-off should not be here because you've already did the journal entries to take them out of your loan balance. So charge-off and recoveries are not a part of this tab 2. This is the loans that you are carrying as of, let's say, December 31st, 2022 or March 31st, 2023, that you have balances for that are in trouble, not performing, have a higher risk than the loans that you have, than your performing loans.
Okay, thank you. Next question. What happens if we have a positive historical loss rate?
Recoveries. Okay, so, on. Okay. If any of these values are negative, meaning recoveries, the question is that going to continue into the future? While CECL allows you to estimate recoveries into the future, we all know that losses are usually more than recoveries. So, and they go in cycle, we lose and we recover. So there may be some timing issues that are reflected in these loss rates and maybe showing a recovery here, but are a negative loss rate. So this is where you take ownership, you take a step back and take a look at the tool and say, well, here's a negative loss rate because we finally got this person to pay us. But is that going to continue to happen for all of our borrowers into the future who get in trouble? Likely not. So this is where you make a qualitative adjustment to take that negative loss rate and make it into be that positive number, which creates an allowance for that particular loan category.
Got it. Thank you. And a similar question, I'm gonna skip down to, since you're on the tool, and I think it's related. On the tool, how do we adjust for our credit union, which has $0 charge-off, however, $1,000 recovery? The tool returns a negative value for the percentage.
Same answer. So, here you would go to, actually, let me see what I can use as an example. So here we have payday alternative. So if I put it will show you things that look, it will shade in red, things that are, looking odd. So what you do is you go back and you go to the adjustment tab and you come up with your best estimate of what you expect your losses to be. And this is an add. So if this value is negative, you add to get a positive, and then you add to get what you expect your target losses to be on that loan portfolio item. So again, things that are negative show up in red. Things that look odd will show up in red. So that targets you to take ownership and go into the model and make adjustments in this qualitative adjustments tab 4 to fix things, to fine tune this tool to fit the facts and circumstances of your credit union.
Very good. Thank you, Chris. Very good. Next question. For audit firms, is there an expectation that the NCUA will have reviewed CECL calculations at all? Or will the year-end audit be the first time this calculation is reviewed?
Actually, I just remembered another question I forgot to answer.
Okay.
Independent validation. Now, there's an interagency policy statement on allowance for credit losses that was just updated. And in that guidance, the recommendation is for a independent validation. Now, validation covers a lot of different things. And, there's no requirement for an independent validation. However, that is the best practice. That, for small credit unions, it may be, getting hiring a consultant to take a look at it, or it may be having people in the credit union who are not involved in this, taking a look at this, to kick the tires, make sure it makes sense. Having another set of eyes that are not involved with coming up with the numbers to do an independent review of this. And as for the audit, we provided on our website documentation, and let me actually go to it. So for the auditors who are going to kick the tires of this tool, I'm going to go to CECL and simplified CECL tool. And here we provide a model development document for the auditors to take a look at so they can understand how the tool works. And they're going to do things like I talked about earlier, taking a look at your loss history and the qualitative adjustments, taking a look at the WARM factors being used, and whether adjustments need to be made to them because, to make sure, they want your portfolio to match up with these characteristics that we use for the WARM factors. Let me see if I can put that another way. It didn't come out the way I wanted it to come out. So, the auditors are going to kick the tires of the model. They're going to make sure that the numbers are accurate. They match to support. And your financial auditors will take a look at, the loss rates and the qualitative adjustments. Do they need to be updated for current losses or what we expect to happen in the future? Or things like, back to those WARM factors. Those WARM factors are based on low-level data from credit unions that are under 100 million in size. But if you're a half $500 million credit union, those warm factors may need to be adjusted because your portfolio is different than the portfolio used to come up with those warm factors. So we've put together documentation here to help out with the audit process. And we also know that you and the auditors will be asking about where did these numbers come from? And
Very good.
we have a tool here. This is for the March 31st tool. Again, here's a disclaimer and resources. But if you enter your charter number, it will show you the loss rate that's in the tool and its recalculation. And on this main sheet recalculation, it will provide publicly available information from your call report and show you the formulas for how these rates were determined. Okay.
Thank you. Chris, is that it? Are you done?
I'm done. Yeah.
Yes, thank you. So thank you. That is actually all the time we have for today's webinar. Again, as Gerardo mentioned, any questions that didn't get answered, we will load up to the LMS along with the recording and a copy of the presentation slides. So I'm going to turn it back over to our moderator, Gerardo Meza.
Thank you, Ron. That is all the time we have for today's webinar. This is how you can contact Chris if you have any questions for him. And I think we have another slide for contact information for our department here. Thank you again for joining us. Thank you, Ron, for posing the questions, and Chris for the informative presentation and answers. I also want to thank our webinar support team, George and France. And again, in a few weeks, we're going to post this entire webinar along with the Q&As on LMS. This concludes our webinar. Thank you.